This is the most vulnerable market there has ever been. And history is pretty clear. Most of the decline occurs after the first rate cut. Let me say, my main interest in the market has been as a historian, and therefore I'm cursed with a much longer horizon than 99% of the players. And I've done my best to tailor to that and live with it. But as a historian, you have to say, if you look at the broad sweep of history, you have to be impressed with how incredibly bad the marketplace is as a judge of the future. So if you'll bear with me for a second, just let's go back to 1929. It's the highest PE on trailing earnings up till then in history. By today's standards, pretty modest, 21 times trailing. The earnings, however, have spiked. They've done brilliantly well. The economy is booming like it was China in its heyday, probably the most rapid period of growth in American history. Double-digit increases in industrial production, that kind of thing. And it peaked in September 1929, September, October, 21 times trailing. And how good was that? It was the highest price in American history. What was it projecting? It was projecting not just ordinary times, not just not good times. It was projecting the worst 10 years in American economic history. So you had the highest PE, the greatest bull market, not a few years before, a few days before the beginning of the biggest wipeout in fundamentals, not the stock market. Yes, the stock market went down colossally, but the economy collapsed, the global economy, international trade, currencies, everything went to hell immediately following the greatest bull market in history. So you have to ask yourself, what was the market doing that it not only couldn't see trouble coming, but it apparently saw heaven coming? It could not possibly have been more wrong. So you fast forward to Japan, which is in a way the mother and father of all bubbles. Japanese market had never sold over 25 times earnings until it did in 87. By 89, it was put to us that it was 65 times earnings. As far as we could tell, the Japanese market was 65 times trailing earnings, never having sold above 25. So it had gone up. And this is what should put the fear of God in anyone trying to time the market. It had gone up 150% more than it ever had in history. What did it predict? From the day it hit its peak in late 89, you had a lost decade, arguably a lost 20 years. The Japanese growth went from sensational to miserable. The Japanese market for 8 minutes sold at a larger value than the US market. For an economy a third as big, it was incredible. And again, we had a sensational PE, not predicting good times, but predicting the worst times that you could possibly have wished for Japan for the next 20 years. If you think about the great financial crash, it wasn't the highest PE in history, but it was pretty darned high. The other day in 08, in early 08. And again, from a very high level, third only to 1929 and 2000 tech bubble. Instead of predicting good times, it predicted the worst financial crisis in modern history, which nearly brought the entire developed world to its knees and needed the most sensational bailouts and injection of liquidity, etc., to save our bacon. Incredible. So if you look at the three great events, or three of the four great events of the 20th century, you have to say absolutely spectacularly wrong. Peak multiples projecting the worst periods of our history. Well, I often quote Hussman. I've actually never spoken to him, but he produces very good data, and it's free, which I always like. And the model that he uses that has the highest predictive value, measuring the value of the market, is slightly higher today than it was at its two previous peaks, 1929 and 2021 December, just before the fairly decent decline of 2022. And now we're slightly higher. This is on the most predictive measure of value that he has produced, and he's worked at that, as far as one can tell, constantly for 30 years. This is the most vulnerable market there has ever been. And given the incredible record of the past, that the highest multiples do not predict good times, which you learn at business school, but have historically predicted the worst times, it should give you cause for some concern and some caution. And of course, the market does not feel concerned or cautious. It didn't in 1929. It didn't in Japan in 89. It didn't in the US before the housing bust of 07, 08. That's the way the market is. So, dear listener, get used to it. You will not be warned. The very best of times, it will feel like the highest possible pricing, the highest possible PEs will be followed not just by tough times, but some of the worst times that occur. That's the historical precedent. Everybody kind of knows, because it was so clear, blatant, if you will. Market peaks in December 21, is coming down pretty steadily. The stock market, the bond market. The worst decline in the first half of 22 since 1939 in terms of loss of percentage value of the US market. And then in November, ChatGPT comes out. And yes, to the insiders, that was spiking for a couple of years in terms of developments. But in terms of the stock market, it was like a bolt across the sky. We knew nothing, and suddenly there it was, ChatGPT, AI was everywhere. And the Magnificent Seven kind of sprang to life. And the rally that took place for the first 10 months was just that, just the Magnificent Seven, almost all making a claim on AI, and the balance of the S&P wasn't actually going up at all. And then in the fall of 23, the rest of the market kind of was won over by the sustained gain and has had a very nice rally, but nothing compared to the rally in the Magnificent Seven. And that extreme concentration has been a factor in several great bull markets. It was in 2000, was in 29 to a lesser degree, but spectacularly in 2000. And here it is again. So AI played a very big role. AI is serious. Whether people will actually make real money is another matter. But is it serious? Yes, it is. It will change the nature of warfare completely. It may be in a year or two, it will be simply impossible to stand up in open space or run a tank into open space. Thousands of well-informed little machines will buzz around your ear and destroy you. It will know who you are. It will have face identification. It will be an alarming tool for governments to know what you're doing, who you are, where you are, and if necessary, in warfare, destroy you. So it will change some very important aspects of life. Whether it will change mundane corporate matters enough to make good money, I think a lot of people, including me, have serious doubt. So it's a very important development. It'll be with us forever, and it will change life in many ways. I'm not convinced it makes the market that attractive. But at the moment, we're in the selling shovel mode, where you sell the chips to people who think they probably can use them and they should be seen to be using them. And everyone's putting a lot of money into developing AI products. And so the chip seller is brilliant. And it's not clear yet whether the people paying for the chips will ever get a return on them. And we'll find out. I don't think it's inconceivable. But it's clear that that produced the oomph to take this market that was dwindling down and produce some fairly spectacular performance, particularly of 7 stocks, and to produce such broad-based enthusiasm eventually that it drags the broader market with it to a pretty decent degree. Well, one of the best indicators of recession is a modest upturn in unemployment. And if you see that in a long-term chart, you'd be impressed. When the market ticks up 50 basis points, 0.5% in unemployment, 70% of the time it's followed by a recession. When it ticks up 0.6%, it is followed 100% of the time historically with the recession. Today it's 0.7. Today it is nicely, visibly above the level that historically has always predicted a recession. Recessions have this slippery habit of taking a little longer than you would like. It's not unique, by the way. They've done that a couple of times in the past. What they haven't done is wriggled off the hook. Once you get the leading indicators, such as the gap between the 90-day and the 10-year bond or whatever, the early warning indicators, and then you get the tick up in inflation, you have always had a recession. And that is the phase that we're in. So I would strongly bet, as a historian, I would just say, you've always had a recession in these conditions. Perhaps you'll get lucky. Perhaps this time will be very different from history. But this isn't 1 or 2 times. This is 8 or 9 times out of 8 or 9. You have always had a recession in modern times. And perhaps this will be an exception. I wouldn't hold my breath. Each bubble is different. We have to agree that the government policy of being stimulatory has gotten more and more intense with the passage of time. Even the great financial crash was nothing like the stimulus delivered for COVID. And once you break out of any historical reference point, it's hard to know what will happen. But one of the things, as a kind of long-term fundamentalist, I should emphasize here is that there's no strong connection between low rates and economic growth. We had a magnificent experiment conducted really by Greenspan. And in the 1986-87 period, we started to do many things, increase the level of debt. And the idea is interest rates work because they allow you to take more debt. And the idea about debt is it stimulates the economy. Well, starting in 87, After 100 years of drifting up in debt to GDP ratio, that's all debt, government debt, corporate debt. It had drifted up for 100 years, and then it kinked at a 45 degrees and went shooting up from 89 until the other day. And it tripled. It tripled the ratio. So you have the biggest country in the world, the biggest economy in the world, I should say, tripling its debt to GDP ratio. What an interesting scientific experiment. That should reveal something. And the growth rate of its GDP slowed clearly and considerably. The growth rate after 89 is 2/3 of what the growth rate is since the war, from 1945 to 89. So you had a magnificent experiment. Increasing the level of debt did not apparently stimulate the economy. It slowed considerably. Now, of course, there are many other factors. It's a very complicated issue. But you would think if debt is so wonderfully helpful to economic growth, it might have at least shown better results than that. And an interest rate is the second derivative. The only significance of a low interest rate is it allows you to borrow more money. But if borrowing more money clearly in the macro level has not had the effect of increasing GDP growth, why would we get so excited with a lower interest rate? Secondly, why would we always forget that most of a market decline occurs after the first rate decrease, as you referred to? I mean, that takes talent because that goes over and over again. We get enthusiastic about the first rate. Oh, just hang on, guys. Wait for the first rate cut. And then we're back to the races. And history is pretty clear. Most of the decline occurs after the first rate cut. Why do we forget it? Because that's who we are. We travel optimistically. And we like to forget unpleasant features.